All right, let's get started. Hello, everyone. Welcome to the Corporate Transparency Act and New Overtime Rule webinar. I'm happy to have Scholley. She is 25 plus years HR and recruiting expert here out in Austin. And then she'll be talking over the new overtime rule. And then we have Stacy. She is a CPA, and she'll be talking over the Corporate Transparency Act of how to stay compliant. This webinar will be action-packed. We do have two speakers. We'll first start with a quick introduction, then hand it over to Stacy to talk about the Corporate Transparency Act. She'll be discussing this for about 20 minutes, and then handing over to Scholley to discuss the new overtime rule for 20 minutes. And then lastly, we'll have 15 minutes at the end for Q&A. So feel free to use the Q&A button down below or the chat, and we'll go through those questions towards the end. And Stacy, I'm going to hand it over to you to kick us off.
Sounds great. Well, thank you so much, Alec, for you and Genwise hosting this webinar covering two new and clearly timely topics. So we appreciate all the participants being here. And Alec, thank you for getting this all arranged and knowing that it's important to keep everyone that's on this webinar updated on all this new information. So happy to be here.
Definitely good to have you.
Okay, I'm going to go ahead and share my screen. Alec, does that look okay? Can you see that?
Yes, I can.
Perfect. Okay, so today we're going to be talking about the basics of the Corporate Transparency Act, and that's referred to as the CTA, and the new beneficial ownership reporting requirements that are required under the CTA Act. So a little bit of background, the CTA was actually signed into law January 1st of 2021 as part of the National Defense Authorization Act. So its purpose is to fight financial crime, money laundering, and any other illicit financial activities. So the main goal of the CTA is to enhance corporate transparency by requiring certain entities to disclose information about their beneficial owners to the Financial Crimes Enforcement Network, which we are going to refer to as FinCEN, or you'll hear referred to as FinCEN. So this information is going to be granted to authorized users such as law enforcement, financial institutions, and others like banking, banking people as well. So they are kind of carrying that out or rolling that out from now until the spring of 2025, with different agencies getting access to this information over that time frame. So we're going to start by talking about who needs to report. So companies are required to report only if they meet the definition of a reporting company. But just to give you an idea, FinCEN assumes or approximates that about 89% of all businesses will have to file under this reporting requirement. So the two companies that have to, types of reporting companies that have to file are either domestic reporting companies or foreign reporting companies. And think about what entity you filed your original documents with. So if you filed documents with like the Secretary of State or other similar office in your state, that is considered the domestic reporting company. If you are a foreign company or entity and you registered to do business in any of the states or any tribal jurisdictions, then you are required to report as well. So there are exemptions, 23 exemptions to be exact, that you may not have to report or that you're not required to report. So what they have found, or what FinCEN determined when they said picked these 23 entities, is these typically have some other reporting mechanism in place already, or they believed that these entity types were not structured in a way that created illicit activities. So some of these reporting types might be like publicly traded companies or banking institutions. And again, those already have some other type of reporting entity in place. But as I mentioned before, approximately 89% of all entities are going to have to file under this new regulation. So the couple of exemptions that I want to just touch on briefly is there's one that's called a large operating company. And under this, to qualify as an exempted entity, you have to have 20 employees in the United States, so 20 employees or more, have a physical operating presence in the US, have gross receipts of more than $5 million in a year, and that is net returns and allowances, and that's also excluding international receipts. So if you fall under that category, you may fall under that large operating company. The second entity or exemption type is inactive entities. And with inactive entities, there's 6 criteria that you have to meet in order to be considered an inactive entity. So one of those is you must have been in existence prior to January 1st of 2020, not engaged in active business, not owned by a foreign person. There could be no change in ownership in the last 12 months. You have no assets or ownership interests, or you have not sent or received $1,000 or more in the preceding 12 months. Now, the reason I bring up these two in particular of the exempt entities is it's going to be fairly easy for companies to qualify in 1 year, and then they may not qualify at some point in the year because they either became active or they dropped below that 20 employees or something like that. So these two in particular, you have to watch to make sure you're continually qualifying. And if you're not, you're going to have to file once you fall in or out of that threshold. Okay, so deadlines. So entities that were created before 2024, you have 1 year to report. So your reports are due by December 31st of 2024. If, though, you've created an entity during 2024, you have 90 days from that report or the creation of that business to report. And then starting in 2025, your report is due within 30 days. So again, if you were created before 2024, you have to report the initial filing no later than December 31st. If you were filed or created anytime in 2024, you have 90 days to report. And any entity from January 1st of 2025 on, you have to report within 30 days. Okay, so the next topic that FinCEN discusses is what's called a beneficial owner. And I want to talk about the term beneficial owner and what their definition is. So FinCEN talks about a beneficial owner as either being someone who has an ownership interest or someone who has substantial control, which is a different type of concept than what we normally think of when we think about a beneficial owner or an owner. So we're going to talk first about the beneficial owner as the ownership interest. So FinCEN describes anybody who directly or indirectly, and this is individuals who directly or indirectly control 25% or more of the owner's ownership interests. Now, ownership interests can include equity, stock, voting rights, but then you also have to think about other types of ownership like capital or profit interest, convertible interest, or options, as an example, or anything else that could be interpreted or represents an ownership interest. So as a practitioner, you might need to calculate the percentage of ownership interest held directly or indirectly for certain client investments, especially if you start to have tiered entity structures. So in the example on the screen, we might need to calculate, or we will have to calculate, if the person who owns entity E owns 25% or more ownership in company A. So as you can see, they start to get pretty complex pretty quickly. So the next piece of beneficial owner is called substantial control. And substantial control is any person that meets the definition of substantial control. And there are 4 main criteria that FinCEN gives us. So the first criteria is a senior officer. So think about like a C-suite. So president, CFO, CEO, COO, CIO. So any person that has these roles or duties similar to these. And where this one gets interesting is a small company may just have someone that they call a bookkeeper or a controller. But if they are acting in any of these roles or capacities, they're going to have to be included on this report as well. So I mentioned there were 4 categories. So the first one is senior officer. The second one has appointment or removal power of any senior officer or the majority of the board of directors. The third category is if you make certain important decisions about 3 categories, either business, finance, or structure, you will also have to be reported. So as an example, if that you have the ability to do any intro or removal of certificate contracts. So if you can write a contract and bind the company, if you're handling any sales and doing contracts, leases, mortgages, or transferring of assets, that would include you as substantial control. If you have, if you're helping with any type of reorganization, dissolution, or mergers, you would also have to be reported. So that 3 criteria of business, finance, and structure, and being able to make certain or important decisions is how they define that. And then the fourth one category, which is a little bit elusive, is they actually term it any other form of indicating substantial control. So they leave this category pretty broad, and we're going to have to look at companies to try and determine or interpret, would that person need to be reported on the report? Okay, so what beneficial owners do not need to be required or reported? So if you are a minor child, if you are an individual acting as a nominee, intermediary, or custodian, if you have a future interest like a right of inheritance, or if you were a creditor, you are not going to be required to be on these reports as a beneficial owner. Now, the next new term is company applicants. So a company applicant are individuals who directly submitted the document responsible for establishing or initiating registering the reporting company, or those who are chiefly accountable for guiding or managing the submission of the legal document. So company applicants must be individuals. They can't be businesses or legal entities, first off. And the second thing that we want to think about is FinCEN says if you are reporting a company applicant, you have to report at least 1, but no more than 2 company applicants. And there's some dates that determine whether you have to list company applicants. So if your entity was in existence prior to 1/1/2024, you are not required to include company applicants. But any entity that was created after 1/1/2024 must include those company applicants. One of the interesting things is in the FinCEN's frequently asked questions, they just clarified that if you are using an online incorporation service, then the company applicant is the one using the online service. So this is if it's like a self-help and they're not providing any guidance, but just simply a portal for you to upload your information. If, though, in another example, you have a lawyer draw up the documents for creation, and then that lawyer sends you the file to go onto this online service, then both the lawyer and you would be company applicants. So there's very specific rules about the company applicants, and I would just make sure that you dig into those a little bit and fully understand who needs to be reported as a company applicant. Now, next up is what information is included on your actual FinCEN report or your BOI report. So first, we're going to talk about the reporting company. So the reporting company is going to list their full legal name of their business, trade names, any DBAs, any name that you go by also has to be listed, and you can have more than one. You're going to have the US address of where you exist as a business, the jurisdiction of formation. So what state or tribal entity was that entity created under or in? And then your EIN, TIN number, Social Security, whatever is attached to that reporting company. Now, when we talk about beneficial owners or company applicants, what information has to be reported? So here, the individual is going to be listing their full legal name, their date of birth, their residential address. Now, if you are a company applicant, you have to list both your residential address and your business address. So if you work for a law firm, you're going to be listing both your residential address and the address of the law firm. Then you're going to be having to list your either a passport, a driver's license, or a government issued federal or state ID that's a picture ID. So you're going to be listing the information on that ID, and then you also have to upload an image of that ID, of your actual like picture on that ID. So there's quite a bit of information that gets submitted with this report. Next up, you'll hear the term FinCEN identifier or FinCEN ID. So a FinCEN ID is a unique identifying number that FinCEN is going to be issuing, either to an individual or to the reporting company. So you're not required to get a FinCEN ID. This is a choice that you can make. So there's two things. Your company can request a FinCEN ID when it submits its first or initial BOI report by checking a box on the form. So that's how a company gets the FinCEN ID. An individual has to go to a specific website that the FinCEN has provided, and you have to upload all of that information I was just talking about. So your picture of your ID, either your passport or your driver's license, all the information on that, your date of birth, address, etc. And then they will immediately provide you with a FinCEN ID. So by having that FinCEN ID, your company can then include that FinCEN ID instead of all of your personal information on their report. So you can either provide all of that personal information or your FinCEN ID. It's your choice. Okay, so there are 4 types of BOI reports. So you're going to do the initial report, and that's the one that is due either December 31st, within 90 days or 30 days. Then you can either do an updated report or a corrected report. So at any time, if you find out that the information that you had previously filed is not correct, you're going to be issuing a corrected report. If, however, someone, maybe just a beneficial owner, changes addresses, you would be initiating an updated report. And then the last category is newly exempt entity. And this one, there's a couple issues. One, if you fall under one of those exemptions that we talked about, those 23 exemptions, if you've originally filed a report and now you're exempt, you would click a button and say, I'm now newly exempt. and they know you don't have to file any additional reports. Another example of a newly exempted entity would be like a nonprofit. They start as a corporation, and then when they get all their exemption papers back and get fully signed up as exempt, then they would submit their exemption report stating that they don't have to file any additional reports going forward. So with these updated or corrected reports, those or the newly exempted reports, those are required to be submitted within 30 days. So if someone, one of your beneficial owners, changes address, you only have 30 days to file an updated report. So unlike a lot of the other types of reports that you have to deal with as a business owner, as an example, there's not an annual filing requirement. You file your initial report, and then you're required to keep this information updated as often and as many times as it takes to keep that information updated. Now, updates and corrections, like we were talking about, those can be triggered by multiple things. So it can be a change of address of a beneficial owner, a death of a beneficial owner. Maybe you added someone as an owner to your company. If you as the company maybe moved addresses or got a DBA, all of those things are going to trigger an updated report, as well as if you get a new passport. So if my passport expires and that's what I've used as my ID, then I'm going to have to give an updated report giving my new passport ID and the new picture on that form as well. So entities that fail to submit a report could incur daily fines of $591 a day. So this is a big deal. And that's each day that the report remains unfiled. There's also an opportunity for criminal penalties that can include fines up to $10,000 and 2 years in prison. So a quick practice issue for attorneys and CPAs, you're going to have to start determining how you're going to be handling these reports for your clients. And clients are more than likely going to need your help in determining who those beneficial owners are, especially if they have tiered entity structures are involved. But as you can see from just this quick overview, there's really a lot of detail and information here that people need to make sure that they're getting accurate. So Secure Compliance does offer a software, and our software is designed for professionals, that's the pro, to help you collect, gather, and organize this information. And then that information is uploaded to the FinCEN's website. We also have a second portal that just helps with beneficial owners, company owners themselves who want to file those reports directly as well. So just know that those two reporting systems or tools are available if that's something that can help. Otherwise, if you have any questions, we'd be happy to have you get in touch with us. We're happy to answer any other questions that you might have.
Thank you so much, Stacy. That was awesome. And we have a few Q&A questions that we'll have towards the end. Rick, thank you for submitting. And now we're going to hand it over to Scholley to talk about the new overtime rule.
All right. Can you see my slide?
Yes, we can.
Okay. All right. Well, welcome everybody. I'm sure everyone's heard about the new overtime rule and overtime pay. And I'm going to be going over the primary parts of this. So first of all, I'll give you a little background if you're new to overtime. The Department of Labor is who regulates and monitors the Fair Labor Standard Act, which is the overtime rule and regulations. And the new rule went into effect July 1, 2024. And basically what we are seeing with the new rule is that there is an increase to this minimum salary level of the regular employees, as well as a change for the highly compensated employees. So the changes that are going into effect is the first is that the weekly salary or minimum salary requirement has increased from $684 a week to $844 a week. So if you're paying anyone salary effective July 1, the minimum salary to be exempt is $43,888. If you have employees that are exempt because they are in the highly compensated exemption, and I'll explain what that term means in a little bit, that is raised from $107,432 a year to an annual salary of $132,694. So what does this mean? Well, the first thing I want to talk about is that we have two different categories of employees. We have an exempt employee who is exempt from overtime. You will think of these as salary employees. And then you have your non-exempt employee, who is an employee who is eligible for overtime pay. And in the state of Texas, overtime pay is followed by the federal regulations, which is any time worked over 40 hours in a work week receives time and a half. If you are in another state like California, New York, they have different overtime rules, and you have to follow the state rules. But today we're going to just be talking about the federal requirements. So why is this important? Well, first of all, willful violators of federal overtime rules may be prosecuted criminally and can be fined up to $10,000. So if you know that someone should be paid overtime and you're not enforcing that, as a manager or a business owner, you can be fined and criminally prosecuted. Second time, purposeful offenders can be imprisoned, and employers who willfully or repeatedly violate the overtime requirements are subject to civil money penalties up to $1,000 per violation. And also, if you are ever audited by the Department of Labor, please know that employees can recover the full amount of unpaid wages plus monetary penalties, which could be double wages, attorney fees, court costs, etc. So it can be a pretty significant hit to your bottom line if you don't do this correctly. So the first thing I want to talk about is determining whether an employee is exempt or non-exempt. And there's two primary criteria. The first is a salary level test. And as I explained, that is being increased to $844 per week. But that is not the only criteria. Salary is just one consideration. The other is what we call the duties test. And that is actually the work that is performed on a day-to-day person's job. It does not mean the title of the job, but what does that person do on a day-to-day? And the Fair Labor Standard Act has exemptions based on different criteria. These are often referred to as white-collar exemptions. So basically, an exemption means that we are looking at the primary duty or duties of a person, and we're looking at least 50% of an employee's work. So let's say that an employee has a duty that is an exempt duty, but it's only 10% of the job, and the rest of their duties are non-exempt duties. Then you would have to classify them as a non-exempt employee. So the Department of Labor, Fair Labor Standard Act has given us several different exemptions. And this is a list of all of the different types of exemptions. And Alec, I believe we're going to be sending the PowerPoint. Are we going to be sending the PowerPoint? Okay. All right. So
Yes.
I'm going to hit the highlights of each one of these. I could do a full day webinar on this, but we're going to cover the top, the key points. So an executive exemption that is pretty much what it sounds like. It's one of your executives. They are primarily responsible for a major department or function of your business. They're managing the enterprise or a department. They are also directing the work of at least 2 or more other full-time employees, and they have the authority to hire and fire other employees. So if they fit these these criteria and they make the $844 a week, then they are an exempt employee. The administrative exemption, this is one that we use often for non-management. And the 2 primary requirements here is that this is non-manual work. So it's office work. So that has to be checked off. But second and most importantly is that the primary duty must include the exercise of discretion and independent judgment with respect to matters of a significance. And that is a very gray area. So I'm going to provide you with some examples, and this is the area that I think is most confusing and where we see the most misclassifications occur. Most jobs that are misclassified in this area that we see at Premier HR Solutions when we're helping our clients identify the exempt status, administrative assistants, even executive assistants, depending on their level of authority in the organization, secretaries, office coordinators, payroll coordinators, office managers, bookkeepers, and accounting clerks. So these are a lot of transactional type of duties, and these are most misclassified. Now, the gray area that I explained is that they must meet this criteria, the exercise of discretion and independent judgment with respect to matters of significance. Now, people will tell me, oh, this employee they have the ability to make decisions. Well, all of us make decisions, right? We're deciding if we're doing accounting, we're deciding what general ledger, right, code we're going to apply it to. That's not a matter of significance. That's a transactional decision. It implies that the employee has the authority to make an independent choice, even if the decisions or recommendations are reviewed at a higher level and upon occasions revised or reversed. So what are some of those examples? Well, the authority to formulate, affect, interpret, or implement management policies or operating policies. So they are forming policies, interpreting it, carrying out major assignments. Now, major assignments means they really have a lot of independence and authority there. They're not just doing the work that's being assigned to them. So in the job description, if you see terms like assist, provide support, that's not carrying out major assignments. Carrying out major assignments would be lead, develop, and implement, those types of terms. Performs works that affects the organization's operations to a substantial degree. Authority to commit the employer in matters that have significant financial impact. So, and that's also including negotiating or binding the organization, signing agreements, the authority to waive or deviate from established policies and procedures without prior approval. Provides consultation or expert advice to management, involved in planning long and short-term objectives, investigates and resolves matters of significance on behalf of management. So if you have an office manager who actually is able to, has the authority to act in any of these ways, then they would be an exempt employee. But if the office manager's primary decisions are, which vendor to use for the copier machine, or paying accounts payable, or the day-to-day just operations of the office, that would not qualify as an exemption. And then represents the organization in handling complaints, arbitrating disputes, or resolving grievances. This is not a customer service rep. It is someone above that that has the ability to make those higher level decisions. So the next is a professional exemption, and these are your learned professionals, your artistic, creative professionals, your teachers, your lawyers, your doctors. And then we have highly compensated employees. So this is going to be a change. July 1, they have to receive at least $132,964. Now, the primary duty performs office and non-manual work, and with the difference between this is if they do not meet the criteria for the other exemptions, but they meet at least one, and they're paid a high salary, highly compensated, they would meet this. Rarely do I see this used, because most of the time you're going to use the executive. These people are going to be in that executive role, or they're going to be in the professional role, or they're going to be in the administrative role. But this is for people that would not qualify for the other areas, but you're paying them a high enough salary. And then computer professional exemption. These are people that their primary duty is working in advanced knowledge of science learning. It's intellectual instruction, invention, development. It does not include employees that manufacture, repair, work on hardware, computers, and software systems. It is really more for your developers, your engineers, your computer system analysts, your programmers. So if you have someone in your office and they just repair the computers, and that's their majority, and install the software, get the printers set up, troubleshoot, and then they do a little bit of this, again, you're going to be looking at, they have to do at least 50% or more of these areas to qualify. And then the outside sales exemption. So, of course, this is, a salesperson obtaining orders, but the main thing here is that the employee must be customarily and regularly engaged away from the employer's place of business. That doesn't mean in your home office. This is truly an outside salesperson who is meeting with clients outside of the office, going on appointments. Inside sales personnel are generally not exempt. And this is another area that I see a lot of misclassification. Now, they do not have a specific salary amount, except that their total compensation must be making minimum wage. So this is different. This is the one that does not have to have the $844 a week. But they have to be outside salespeople, and they have to meet minimum wage. All right. So you're probably, usually when I give this presentation, there's a lot of questions, because I've usually presented an area, or we've discussed one of the categories that people are begin to worry about. So what should you do? I mean, this has gone into effect July 1. Well, the first thing you need to do is look at your pay roster. All of your exempt employee salaries, you need to make sure that those are meeting the minimum of $844 a week, or $43,888 annual. The next thing that is equally important is to review their job descriptions. Which one of the categories do they fall under in regards to classification? And identify what exemption would they qualify for. And then lastly, those people that don't meet the duties test or don't meet the salary test, you have to make a decision. If they don't meet the duties test and they meet the salary test, you have to reclassify them as a non-exempt hourly employee. If they, let's say they meet the duties test, but they fall below the $844 per week, then in order to keep them at salary exemption for overtime, you have to increase their salary. Now, fun stuff here. We're going to see another increase. January 1, the FLSA salary threshold is going to increase again to $1,128 per week. So many of you may be okay now, but in January, to meet this annual $58,656, that may pose some problems with some of your salary people. The highly compensated employees is going to also increase to $151, $164. And then starting in July 1, 2027, every 3 years, there is going to be an adjustment made based on current wage data. So for employers and managers that have been working for several years, you know that we went, gosh, 20 years, maybe longer, before we had any kind of increase. And then all of a sudden they wanted to increase it originally to the $50,000 level. And, it was too much for employers to go from the previous. So they did a minor increase. Then now July 1, they've done another increase. January 1, they're doing another increase. And then you're going to see this again in 2027 and thereafter. What is happening is that, a little history lesson here. When we started, the Fair Labor Standards Act was enacted in the 1930s. We really had white collar workers, office people. If you worked in an office, you got paid a salary. And then we had blue collar worker, tradespeople, people that did manual work. You got a lower wage and you were eligible for overtime. Over this last several decades, the FLSA standards and their review of exempt and non-exempt has drastically changed. And we are seeing that most of the classifications are management or professionals, and many of the administrative jobs that were salary before are now being classified as non-exempt hourly. So what do you do in regards to this with your employees? You definitely need a communication strategies, because let me tell you, people are not going to be happy about changing their status to hourly. Some people are going to see this as a demotion, a loss of flexibility. They're going to be, maybe if you do have to change them to an hourly employee, you may not have the budget to pay overtime. So there's going to be more pressure for them to meet the job requirements without the ability to work extra hours. They're not going to like clocking in and out. They're going to feel that they're no longer valued. So the communication strategy is very important. What we typically tell our clients to communicate is that, every year the Department of Labor comes out with updated regulations, and that as part of that, you did an audit and you needed to make some changes to be compliant. All right.
Awesome. Thank you so much, Scholley.
Sure.
Awesome. That was a lot that we went over in 45 minutes. We'll be sending a recap email tomorrow of the recording of the webinar, also the deck, and then links to schedule a time with Scholley or Stacy. So we're now going to transition into our Q&A. Stacy, when we first met on the Corporate Transparency Act, at the end I asked you, I was like, why is the US doing this? And you mentioned that the rest of the world is already reporting this. The US has a lot of illegal activities that's happening through businesses and cracking down. Could you just speak a little bit towards that before we go into Q&A? Because when you mentioned that, I was like, okay, this makes more sense why they're trying to bring the Corporate Transparency Act out. So I thought they were just trying to spy on us, but they're trying to get more regulations down. I think you mentioned something about IMF as well. So if you can kind of give us a little bit of that story there to add additional context on this Corporate Transparency Act, that'd be awesome.
Yes, thanks, Alex. So yes, there's actually many countries that have been doing this same type of reporting for many years. And so that's one of the things that the US was starting to see was more and more companies were coming to the US for money laundering and those types of things because they realized that we didn't have this kind of reporting requirement. So the US has gotten some pressure from other outside organizations, other countries saying we really need to be reporting on this as well. So that was one of the reasons why this was put into law.
Thank you for that additional context. And now we got about 5 questions. I'm going to start off with Rick. This is over the Corporate Transparency Act. If the organization does not meet an exemption, do they still need to file an initial report starting the exemption or stating the exemption?
So if you do meet one of the 23 exemptions, Rick, you do not have to file an initial report. But you would want to have some sort of documentation in your file just in case to show why you are exempt, but you are not required to file a report if your initial report would be an exempt status.
And then one more follow-up question from Rick as well regarding the CTA. Are individual legal entities treated separately or companies with common owner, one person, treated as one entity?
Yeah, Rick, so if I'm understanding your question right, there's two things. So when we think about like an individual LLC or a single member LLC that may be disregarded for tax purposes, right? It may just show up on a Schedule C. That LLC still has to file a report. So if that's what your question is, each entity, and if I read a little bit more into your questions, even if you have several entities and they're all owned by one person and maybe they're just layered or tiered, you might have an S Corp and then several LLCs, each one of those entities is going to have to do a separate reporting. So if you need more clarification or have a different question other than that, just put it in the chat and I'll be happy to answer that as well.
Thank you, Stacy. And then one more from Sarah. My company has 2 partners and both of their spouses are on the entity documentation. Do I need to include the spouses as the beneficial owners?
So if those spouses are listed as some sort of members or owners of that company, then yes, they're going to have to be listed on the beneficial owner as a beneficial owner. The other piece to that is even if they may not be on those entity documents, but they're doing any of those activities that we talked about for substantial control, sometimes you'll pull a spouse in from a substantial control piece. So your initial question is, do they need, if they're listed on the entity documents, do they need to be included? Yes, if they have some sort of ownership in that business. And then secondarily, even if they don't, and they're doing any of those things that were listed as substantial control, they may also have to be listed.
Thank you.
Which
Scholley,
is what makes this interesting, right? So you end up having to really look at those organization documents to see who actually is listed as potential owner of those entities.
Awesome. Thank you. And Scholley, I have a few questions for you. Does this apply to all businesses or maybe those that are above a certain employee threshold?
The overtime is 1 employee. So if you have one employee, you know, it does. Somebody asked me an interesting question as if they have to, if you're an owner. And that is an interesting question. You know, if you're an owner and, you know, that there was a husband-wife and the wife was doing administrative work, you know, I think in that case, you know, you're fine, because you own the entity. It's just like an owner working and not paying themselves. They don't meet the minimum threshold, right? But other than that, it's any employee that's not an owner, you would have to meet.
Next question is it both salary and duties or one or the other?
That is a great question, and that is the most misunderstood of all. It is both. So oftentimes I meet with clients and they go, "Oh no, we pay them the minimum salary." That is step one. Step two is the duties. So even if you pay them the minimum salary and they do not meet the duties test, even on the highly compensated, you know, or the executive, you must meet both.
Mm. And is there another salary non-exempt classification, or do they have to be paid hourly?
No, you could pay someone a salary. You know, you could pay a salary, but the problem that you're going to have is the record keeping. So you have the burden of proof is on the employer. You would, let's say you pay them a salary, but you would have to pay them any time worked over. So, you know, you can pay them a salary, but any time worked over 40 hours, you would have to pay them additional pay, which is time and a half. And you have to manage that record keeping, time record keeping. So, unless you can guarantee and prove that the employee never works overtime at all, it's an administrative nightmare. So that's the only thing you've got to understand is that if you pay someone a salary and they don't work overtime, that's fine, as long as you pay them the minimum wage. But the problem is proving without them clocking in and out or submitting a timesheet. How are you going to prove that they did not work over 40 hours?
Hmm.
Does that make
Thank you,
sense?
Sean. Yeah, I don't see any additional questions. Scholley or Stacy, is there anything else that you'd like to add on your topics before we conclude?
I just want to say, you know, if anybody has any questions, you're going to get my contact information, my email. You know, send me an email. I'm happy to hop on a call, complimentary call with anyone and just, you know, discuss any question that you have about, you know, the new overtime rule and classifications.
Awesome. Thank you. Stacy?
No, great. I'm great. As far as if there's anybody that has questions again, just holler. FinCEN does have a really good kind of basic knowledge base of what FinCEN is or BOI reporting. We also have one on our website as well, a white paper. But those have some really good tips and information as kind of a good starting point.
And Stacy, is that the white paper you gave to me to add in the recap for them to have access to?
Yeah, I think that was the basic. So it's the
Good.
basics white paper. Yeah, that's a really great place to start for just some of this general information.
Awesome.
I think the other important thing to remember is there's a lot of new terminology that we haven't heard before in any other context. And some of the words like FinCEN ID actually have multiple meanings. So it's just really making sure that you have a clear definition or understanding of what that terminology means and where it applies.
Awesome. Well, thank you so much, Stacy and Scholley. This was a great webinar. I'm just still shocked how we were able to get 2 big topics in within 1-hour webinar. So kudos to y'all for doing that. And to all the participants and attendees, thank you so much. We'll send a recap email tomorrow. This will have the recording, accessing the white papers, the presentation. Also, our next webinar, which is about honing in the sales of getting your pricing model down, how to get monies in quicker with your clients. We have Michelle, the Queen Pitch Coach, that will be joining us August 14th. And that webinar will be listed in that recap email. Thank you so much and have a good rest of your day.